So this is part 2 of the lecture for week 2 for our lecture videos. And we're just in the middle of preparing our financial statements. We had prepared our income statement where we're showing our revenue and expenses, and we're taking these figures off of the worksheet that we completed in week 1 at the top of the page. And now we're basically preparing our statement of stockholders' equity, which is a bridging statement that's going to get us from our income statement to our balance sheet. And what we're doing is we're summarizing the changes that have happened in our stockholders' equity section. The first change, of course, is the issuance of common stock, so we've accounted for that. The second thing is that revenue and expenses are part of stockholders' equity, and those are part of retained earnings. But if you look over on our income statement, we've already summarized revenues and expenses. So what we're going to do is we're just going to carry over our net income from our income statement. So we're just going to carry that over. There's no sense repeating all of our revenues and expenses a second time. Since we already have that on our income statement, we're just going to carry over just the total of net income onto our statement of stockholders' equity. And of course, revenues and expenses would be part of retained earnings, which means that net income is part of retained earnings. So we're going to have the $8,500 included in our retained earnings, and of course also in our total. And of course that's a positive number that is going to increase shareholders' equity because revenues increase, expenses decrease, and revenues are larger, and so net income of course would end up increasing shareholders' equity. In this case they increase retained earnings because that's the category of stockholders' equity we're talking about. So that's the other piece, that's this piece. The only other thing up above is dividends. And dividends, of course, is a negative amount, and that's a return of earnings to the shareholders. So we're going to include dividends. I'm just going to abbreviate. And of course, that's part of retained earnings. So retained earnings are accumulated earnings less any dividends or return of those earnings to the shareholders. So we have earnings of $8,500, and in this period we paid back $3,000 in the form of dividends. Again, here you wouldn't necessarily have to show that as a negative. I'm doing it just because some of these numbers are positive, some are negative. And we could do the same thing over here with expenses, right? We could show these as negative if we wanted to. Either way, you may want to do that just so that you don't make a mistake and add those. So we can always just keep negatives as negatives and positives as positives. Okay? So then, so now we've accounted for this piece. So we've accounted for all the changes in our equity account, stockholders' equity account. So then we're going to end up with what's called our balance on January 31st. And so our balance January 31st of common stock is $30,000. For retained earnings, it would be an increase of $5,500. And in total, we'd have a total increase in stockholders' equity of $35,500. So that's how we complete our statement of stockholders' equity. Again, taking those amounts off of the worksheet, putting them into statement form, and really just taking any common stock that was issued, taking the net income right off of the income statement, and then subtracting any dividends. And now what we have is we have the total balance in our common stock account and the total balance in our retained earnings account. And we're going to use those to place on our balance sheet on the next statement. So the next statement is in fact our balance sheet. Again, same heading, a company name, name of the statement. But the balance sheet is going to be at a point in time. It's not for a period of time. We want to know what our financial position is at a point in time. How much cash is in our account as of January 31st. Not the total change throughout the month. How much is there today? If you looked at your bank account, you want to know how much is in there right now. You don't care how much has been in and out throughout the month. How much is there right now? So that's why the balance sheet is at a point in time, and it's right at the end of the month. It's on January 31st. Okay, so it's at a point in time. So that's the difference between the other accounts. All right, and so the balance sheet, again, that's where we're going to basically be able to address liquidity. We're going to see what our resources are relative to what our debts are and how we're able to cover those debts. And again, if you think about this, this kind of looks like our accounting equation. So we've got assets on one side, liabilities and stockholders' equity on the other side. And so it's aptly named the balance sheet because we have to be in balance. And it does look like the accounting equation. So we're going to start with our assets. The first asset is cash. And again, we're going to take these right off of our worksheet. So cash was $32,500. So that's that figure there. Accounts receivable. Money that's owed to us was $2,000. That's an asset, of course. That's money that's due us. We just need to collect it. And then supplies. Supplies is an asset. It's going to help us generate revenue. And that's $2,000. And so that's total assets. Put a total down here. And that's $36,500. I'm going to abbreviate a little bit here just because I'm running out of space. Liabilities, we have accounts payable, $1,000. So that's this figure. And now for stockholders' equity, we're going to use two accounts. We're going to have common stock. And we're just going to take that right off of our statement of stockholders' equity. So we've got our $30,000 right there. And retained earnings. And again, I'm just abbreviating to make things simpler. But in the book, you'll see how that's spelled. That's 55. And so we have total stockholders' equity. I'm not going to write that all out right now. $35,500. And if I add that to my liabilities, so liabilities plus stockholders' equity, I get $36,500. So my total liabilities plus my stockholders' equity, and I'm just going to put an E for equity. Of course, that would be spelled out. But again, $36,500 and $36,500, I'm in balance. So my balance sheet is in balance. My financial statements are in balance, and that's because all my transactions up above were all in balance. And if I prepare my financial statements properly, my balance sheet should end up being in balance because all my entries were originally all in balance. So, so now I've got my three financial statements prepared, and that's basically the mechanical part of this chapter. So I'm going to move this down a little bit, and we're going to just take a look at what we can understand from a profitability point of view and from a liquidity point of view. So here we have our financial statements. First of all, we're going to look at our income statement. and we're going to look at what we can understand from a profitability point of view. And again, the whole purpose of financial accounting is to be able to put together accounting information into a usable format, which we've just done, and then from there to be able to use that to make decisions. But before we can really make decisions, maybe we can make some observations and then be able to understand how ultimately we can use that to make decisions. So from a profitability standpoint on our income statement, first thing that we could probably make note of is that yes, we are actually profitable. We made $8,500. So that's certainly one observation we can make. And we can also make the observation that, we are profitable even in the first month. And I'll put a little exclamation point there, because a lot of companies, it takes months or even sometimes years to be able to become profitable. For those of you who are maybe familiar with the car company Tesla, it took them years to become profitable. And even now, there's many quarters in which they are still posting a loss, in spite of the fact that they're worth billions of dollars in the stock market. But many companies run at huge losses, especially tech companies, startup companies, for many, many months and even years before they make money. So we've made money in our first month of operations. So that's something that's actually noteworthy. The other thing we could look at is we could look at the ratio of our net income to our sales. So we could look at 8,500 to 10,000. And we could see that that's 85%. Now, we could look at that relative to other companies that are in the same industry. We could look at this relative to future months. But, of course, 85% is a pretty high number. If we looked at some of the tech companies, they're probably in the 20 to 30% range for net income, maybe a little bit higher before taxes. But still, 85% would, obviously, if this could be sustained long term, that would be a hugely profitable business. So that's an observation we could make. The other thing is we could look at our expenses and say that basically our expenses are at $1,500. If in fact that's going to be roughly our expenses each month, we could make an observation that $1,500 is about where we need to generate revenue to break even. So as long as we generate at least $1,500 of revenue to cover the $1,500 of expenses, we're going to reach a break-even point. So again, all those things can come out of just a pretty basic income statement analysis and to help us make decisions. So how about moving over to the balance sheet? Liquidity. What could we say about liquidity? Well, first of all, liquidity is a function of being able to pay our debts. In this case, our debts, of course, are our liabilities, and so, we'd be focusing in on $1,000. So first of all, I think it's pretty clear that our assets of $36,500 greatly exceed our liabilities. I don't think there's any question about that. Second of all, I think that the cash that we have on hand greatly exceeds our liabilities. So at this point in time anyway, and granted the company is just beginning, but we still have a lot of cash, a lot of resources relative to our liabilities. We're in a pretty good position liquidity-wise. But let's just say hypothetically, let's say our cash balance is only $500. Now we'd be a little bit more concerned. We would be wondering, how are we going to meet that $1,000 obligation that's coming toward us? Then we might have to think that we're going to have to start to maybe collect these accounts receivable so that we can get that full $1,000. So that might be an action that we would have to take to begin to accumulate enough money to pay for those debts. Let's say that we could not collect our accounts receivable. We're probably not going to run out and sell our supplies. We probably have to source money elsewhere. So again, all part of the decision process.